There's pre-tax, which is your qualified money, which is things that have not been taxed yet that you owe the tax on later, 401ks, all that kind of stuff. Then there's your after tax, which is your brokerage accounts, things that have you've paid taxes on, but you haven't paid it on the earnings, the growth of it or the loss of it. So that's the second bucket. And the third bucket is the no tax. And you get to that no tax in terms of a Roth conversions or Roth money, where you use post-tax money and then it grows tax-free and you take it out tax-free, or loans against life insurance, cash value life insurance. Those are no tax.
Welcome to the Build Wealth Your Way podcast, where fearless women take charge of their financial futures. Get ready to tap into your potential, embrace your leadership, and join a community dedicated to your success. Each week, we'll dive into empowering conversations, expert insights, and actionable tips to help you build the life you've always dreamed of. Don't settle for ordinary. Let's shape extraordinary together. It's time to rewrite your financial story. Tune in now and let's start building wealth your way.
Build Wealth Your Way is sponsored by PCMA, home of ProspHER Success Hub, a 3-in-1 business coaching program for women.
Gayle, how are you today, ma'am?
I'm doing wonderful. Good to see you again. Another week, huh?
Good to see you. Another week, another session, another episode. I'm excited about it.
Me too. So we're talking about diversity today, right? How diversity drives success.
Diversification.
Yes, I guess. I know that's a little bit different. I have to clarify that in today's world.
A little bit. I cannot talk very well about diversity. That's not my lane. Yeah. But I can talk about diversification for sure.
I like it.
And what I like about this is when we get to do episodes like this, it helps us highlight how we have two different perspectives, right? The idea that we both care about helping women build wealth their way is always in sync. However, we can talk about that from the perspective of real estate investing, and then we have you, who's the guru of all things traditional investing. So what a treat.
Yeah, we have our own diversification of finance going on right here.
There you go. So I guess we can talk about diversity too. Diversity of finance. Good for us.
Yeah.
So I was pretty much thinking about like how I came about thinking about diversification of investments. And probably not oddly enough, I thought about it from the perspective of me having been a real estate investor over 20 years and how I did it all wrong. All wrong. Yeah. So I was like a lot of real estate investors, Gayle. I was uber focused on acquiring single family homes. And I just lived in that space for a long time. I got fixated on it and I had blinders on, which at the end of the day means I lost a lot of money. And we rest in peace to the opportunities that I lost. Yeah. But maybe you can speak to it. Like I feel like we become experts at something sometimes, and we just kind of run down that lane and don't consider other options. I mean, is that something that shows up for you?
Absolutely. And I think in the traditional investing side of things, we kind of get hung up on those things that gets airtime. It's like whatever people are talking about at the time, or we might hear Kramer on, whatever channel he's on in the investing side of things, or we hear, different stock picks and what people ought to do for that. And yet there's so much out there, and everything that somebody says is really just designed for just a split second in time for a certain group of people. And it may not even pertain to you, but that's what we hear. And we think we should do that. So diversification it's just so much broader than just what we hear. And we think it is in terms of real estate or in terms of, stocks and other financial tools.
I think it was you that came up with the name of this episode. It's a balancing act, how diversifying drives success. And what I like about it is that even what you just said, we have to be the masters of our universe in every aspect of what that means. And when we really take a position of being the on the in the front seat, in the driver's seat as women, with when it comes to money, it means that we can tune out the noise because we have something that's been designed for us, for where we are in our lives, and for where we're going. So I love that you pulled that out, like the noise, because same thing happens on the real estate side. You know, you hear some guy on TikTok or some woman on Instagram talking about her flipping houses, and now all of a sudden you want to flip houses.
Right. And they make it look so easy. And like, there's like 100% chance of success if you do these steps. And it's like, okay,
Yeah.
that's not the
Yeah.
case.
Not at all. Not at all. So let's get into it. I mean, we've talked about what it kind of looks like right now. Why do you think it's important for clients to really think about this concept and to drill down into it?
Well, I think a lot of it has to do when you're thinking about diversification, because as I was preparing, my show notes on this, it was like, well, what does that really mean? And why is someone doing it? And there's several reasons, but the main focus that kept coming into my mind is risk. I mean, diversification spreads risk out over multiple avenues. And if you think about, I thought about insurance, because if I look at my budget, insurance has to be the biggest line item in my budget. I mean, when you're talking about car insurance and health insurance and medical insurance, I mean, if you add up all the insurances that you have, it's a big portion of someone's budget.
Yeah.
And why do we get insurance? And really, all we're doing with insurance is we're paying someone to assume risk for us. We're paying someone to take risk off the table. So when you're having a diversified portfolio, really what you're trying to do is reduce that risk and spread it out over a multitude of avenues. And so I think that's a really important part that people need to consider as to, so why is it important? And for a lot of people, whether in your retirement, they need to really think about that, because they don't have the luxury of time to make mistakes. And if you're a younger person, many times you don't have the dollars to blow, right? To lose, because you put all your eggs in one basket. So really taking a look at where you are in terms of your continuum on your investing, and then coming up with a smart diversification strategy that spreads that risk out over a variety of different avenues.
I like that you came at it from the perspective of risk. And I think when it comes to real estate investors, there is inherent risk. However, the thing that came to mind when I was preparing for today's show is missed opportunities.
Okay.
So what happens in our world, and I just spoke about it, is that we spend 99% of our time as real estate investors focusing on acquiring real estate and maintaining it. In most cases, 99% of our time, we want to acquire as many properties as we can, and then we go about the business of maintaining them. However, the problem with that is we set it and forget it. So we buy it, we maintain it, put tenants in the properties most cases, and we just, are on the other side of the phone if somebody calls and says something is broken. And we like to rest on the fact that there's just going to be accumulation of appreciation and it's going to be all great, and I'll just give it all to my grandchildren.
Yeah.
But the problem is the missed opportunities in that thinking. And so I love the idea of diversification, because it's interesting. If you set it and forget it, and you're not considering whether you should pull money out, put it in the stock market, pull money out, buy different classes of properties or something like that, you're losing money. And so
how often what would you recommend in terms of someone, how often should they review that? Is that like a weekly, a monthly? I mean, what would be your advice for someone that is in multiple real estate classes?
So typically what happens in our world is we think about our real estate portfolio once a year at tax time, because the tax guy is going to ask us what the value is
Okay.
from last year to this year, right? and that's it. But the truth of the matter is we should be evaluating our portfolios no less than every 3 years, depending on the size of your portfolio.
I see. Okay.
And we'll get into it, but the truth of the matter is not only are there missed opportunities, but there is a law of diminishing returns when it comes to just putting the money in a property and walking away.
Oh,
There is
yeah.
definitely some issues with that.
So when you
So
talk about missed opportunities, go a little bit deeper into that. So can you give an example of a missed opportunity? Like you had money tied up and you should have bought a different type of holding, or tell me about
yeah.
that.
Yeah, I'll tell you, like, even in my own journey, I told you I spent most of my time acquiring single family residences,
Mhm.
single family homes in Indiana,
Okay.
right?
Uh-huh.
Not considering the fact that had I changed geographies and bought properties in other states, I could have made more better money.
Sure.
Or B, I changed asset classes. So maybe instead of single families, I should have been looking at apartments, or I should have been looking at buying a commercial building or something like that. I should have been considering all of those things in
Got
terms
it.
of diversifying my
Sure.
portfolio.
That makes sense. So
Yeah. Yeah.
good.
So there's a lot that goes into it, and obviously we won't answer everybody's questions in this particular episode, but we definitely want to pick your brains and make people think. So, Gail,
Absolutely.
what does it look like when somebody comes and sits in front of you and you see that they put all their eggs in one basket?
Yeah. So, there's different ways that we like to help people think about a good diversification strategy. I had a client come to me, and I may have shared this on a previous episode, but I asked her what was important to her regarding her money. And she's like, well, I want my money in a place that's safe. I don't want to lose it. And then she said, I also want it so that I can get big returns, but then I also want to have access to it. And I'm like, I said, that would be great. I wish I had one size fits all, but unfortunately there's not a product out there where all of that can be accomplished. And so what we did with her, as well as with all of our clients, is we kind of take a look at putting into different buckets of safety, having a certain amount of money that is going to be safe, that if the market dips, you're not going to go along with that ride. The other bucket is of growth, and that might be where things that you're really to put your money in, that you're going to assume some higher risk, but you're also going to get the higher rewards. And then the third one is liquidity. We all need to have a certain amount of our income, or rather of our assets, that we can get to at a moment's notice, so that we can take care of the ups and downs of life, because life happens. Many times we need to have that money available quickly. So a great diversification strategy from that aspect is making sure that you have it allocated in that and what you're comfortable with in terms of safety, liquidity, and growth. So that's one main strategy that we spend a lot of time focusing on.
That's good. I have a world in the real estate space where I coined the term ICE. And the way I go about helping clients with this kind of topic is determining whether or not with each property they should invest more, sell it, or exchange it. ICE. Invest,
Oh,
sell,
okay.
or exchange.
Got it.
So, just like you, the strategy for whether or not it makes sense to do either of those things is going to be tied to their long-term objectives, kind of taking a look at where they are today, where they want to be later in life, and what they want this portfolio to do and how they want to, move along in the journey. But it's a strategy that a lot of times people are missing out on because they just are not thinking about it. And I'm glad that you're on this call, not on this call, but in this episode, because I know you love to talk about the tax partner, the
Sure.
partner that is
Right. Yes.
the
Yeah.
tax man. That's apparent in my world as well. As a matter of fact, one of the really cool things that I get to do. And I have this little title, certified real estate investment professional, whatever. But one of the things that I get to do is I get to talk about whether or not it makes sense to trade in those, not trade in, but sell
Yes.
off those single families to buy a bigger property and take advantage of some tax laws that work in your favor to do that.
Yeah, we call that in tax loss harvesting. That's
Okay.
yeah, that's basically what we also do with certain stocks and such is that you take a look at your winners and your losers, and it's going to impact basically capital gains, right? Because that's typically going to be in like an after tax bucket. So you have to make sure that if you're following it correctly, you October, November, sometime toward that end of the year, you look at what those losers are, sell those so that you can have that to write off any of those gains. And oh my goodness, the statistics that we can show in terms of your tax savings can just be phenomenal. But it takes something, some professional sometimes to be able to help you figure that out, because
Oh, yeah.
it's
Oh, yeah.
there's a lot of math involved and a lot of software and all that kind of stuff. But it's important in traditional investing, much like it is in real estate, to minimize those taxes as much as you can.
Yeah. So in our world, it's the 1031 exchange that
Yes.
is
Okay.
kind of similar to what you're talking
Right.
about. And it gives you some advantages as an investor to being able to manage and really benefit,
Yeah.
from real estate in a major way. I had a gentleman come and see me a couple months ago, and he was amazing. He was somebody, I think I might have told you on another episode, that had been kind of tracking with me. You know how you meet somebody and they're just not ready to do something in the
Sure.
moment.
Yes.
But some months went by. He actually lived in Utah, and he had come to Indiana to visit some family and made an appointment with me, he and his wife. And they specifically talked about the missed opportunities from not doing a 1031 exchange and
Oh,
selling off some property and
sure.
having to pay taxes on the gains and
Yes.
I mean, he was heartbroken. And quite honestly, Gail, I felt a little bit, I don't want to say guilty, but I knew him in that period of
Yes.
time,
Yeah.
and we never talked about it because I never knew he was ready to sell.
Sure. Well, and
So,
it's one of those that you know, you can only do so much. I mean,
yeah,
I didn't know all of that at the time, but yeah, I mean, I just think that goes to show that it's something that we always have to be cognizant of and understand that that's a big portion of money that can stay in your pocket if you're aware of it. But I want to go back to something you had mentioned earlier. It's been kind of want to know the answer to this, but from a real estate investing side of it, do you do a lot in terms of diversification along a timeline? Like you're supposed to have so much in with that, you're ready to sell within a year, or some you want to hold 3 to 5 years, some you want to hold to 10 years. Is that play a big part of diversification in real estate?
it doesn't play a big part, but there are some nuances to that. So it kind of goes back to what is the end goal?
Okay,
What do you want? For some, after having invested in a property, you want to hold it just to try to get some gains back,
sure,
depending on how much you put into the property, right?
right,
But then in other cases, if the economy is moving in such a way where you really kind of got to get rid of the stinkers, sometimes it doesn't matter.
okay,
So there's a lot of factors that go into it.
okay, yeah,
Yeah.
good,
Yeah. So one of the things I've been thinking about, like from the stocks, bonds, mutual fund perspective, because you don't know what you don't know, how does somebody go about like having a discussion, or what approach should they take when they're talking to their financial advisors about diversification? Because when I think about it, it's overwhelming.
yeah.
Like the amount of vehicles out there to invest in is overwhelming. And I promise, I feel like they add vehicles all the time.
Oh, right. Yeah. Well, and I think it's the one thing with when you're looking at traditional investing, it's one of those where it's always the shiny object in terms of we think about the product itself. We think about stocks, and we think about ETFs, or we think about mutual funds. And for a financial professional like myself, those are just like arrows in the quiver, right? It's really just a tool to help you get to what you want. And so what's more important, as opposed to really looking at a specific product, is asking yourself, what do you want that specific product to do? So if you want it to grow, then there's going to be certain things that you would put it in. For instance, you'd put it in the market, and within the market, there's certain things you could put it in, but you do that more than you would put it into fixed income, which is your bonds. So it's more important to figure out what your goal is versus what the product is. Then the second part of that is, again, from a tax perspective, is really when you're looking at the diversification, especially as someone starts getting into pre-retirement or retirement years, is really looking at what tax bucket that money is in. And so basically there's three different tax buckets. There's pre-tax, which is your qualified money, which is things that have not been taxed yet that you owe the tax on later, 401ks, all that kind of stuff. Then there's your after tax, which is your brokerage accounts, things that have you've paid taxes on, but you haven't paid it on the earnings, the growth of it or the loss of it. So that's the second bucket. And the third bucket is the no tax. And you get to that no tax in terms of a Roth conversions or Roth money, where you use post-tax money and then it grows tax-free and you take it out tax-free, or loans against life insurance, cash value life insurance. Those are no tax. So it's really important to figure out those where money is going to be invested in those three buckets. And as you get into retirement, having a plan as to which one you're going to draw down first is critical, because it's like a tripwire. One tax withdrawal or one out of a certain bucket can cause 3 or 4 other taxes that you would have no idea is going to happen. So it's really important to really think through how all of that's going to play out. And that's why we create tax maps for families to help them figure all of that out, because it certainly can get overwhelming. And it just, without, programs and software and all that kind of stuff, I mean, it would be difficult to do, but it's very important to have that discussion.
I love that. Tax maps.
Yeah.
Oh my gosh, everybody needs to go see Gayle for a tax map. That is amazing. So I don't have a tax map. I wish I had like a fancy.
You had a fancy term or something.
What I have is a calculator.
Yeah.
But no, like on the real estate investing side, like I do have kind of like some auditing tools to be able to look at a portfolio and say, all right, here's where the stinkers are, or here's a property that's actually covering up for that property that's costing you money, that type of thing.
Right.
And then we can do some modeling and that type of thing. But regardless, it always comes back to the same thing you said, which is, what is the goal?
Oh, sure.
What is the goal? And I want to emphasize this too. Like we talked earlier about the fact that folks are there's a lot of noise out there in terms of folks telling you what to do and how to do it. And I'm just going to emphasize again, before you take any steps, you need to determine what's important to you and your family. Because what I found is, and what I've seen a lot is, I get people who are coming to see me after they've seen several other people, and they've got all these ideas in their head that don't necessarily make sense for them, but it's hard to unwind that.
Right.
That makes sense.
Created a bias, right? They've a preconceived idea, and they haven't vetted it out to see if it's actually true.
Yeah. So when I sit down and say, well, what is it you want to do? And I get a blank stare back, that instantly tells me you've not done the work before you came to see me, for me to be able to guide you. Because that's it. I don't necessarily want to lead you, but I prefer to guide you to where you're going.
And I think sometimes too, a lot of, at least in when I see some families, they come to me and they don't know, like they get to especially as someone gets a retirement, and I'm like, what are you going to do? I'm like, nothing. I'm like, well, I mean, that might be okay for a week, but then after that, you're going to have to do something to fill that void, to feel significant and important. So sometimes a lot of what I do is help them think through those things that provide value and happiness to them, because it's hard if you don't know. You need someone sometimes to help you guide through that, but it's so important because that is the thing that sets the tone for everything else that's being done.
Yeah. And, while we're here, I also think it's important, and we've talked about this before, but it's important that the people that are helping or assisting you in one area are aware of the other professionals. Because
Absolutely.
I won't forget the wealth management lunch you had some time ago, where you talked about, well, the CPA has this particular perspective and this is what they're thinking about. But a wealth manager is thinking about, and they need to know what each other are doing so that they can really provide a benefit to you.
Well, right. And I think what we look at is we help you plan, for your life. Your CPA helps you plan for the next year. I mean, it's just a whole different perspective, and they're looking rear view mirror. We're looking in the front mirror, through the glass, trying to project out before, that 12/31 of that year hits. Your CPA can only do so much with what's already been done. And we like to try to help map that out before that happens, to develop that strategy. But, part of the real estate investing side of things, many times we just look at that as an alternative asset. So if someone, you mentioned you don't have the tools and the resources like what we have, but that's okay, because you're still dealing for the most part, in the after tax world, right? You're dealing in, you know, capital gains and all those types of things, and being able to have that as, how is that going to impact your tax statement? We can kind of pick up where you left off in helping figure all of that out, because we look at real estate investment basically as another product, as another tool that is available for people to earn money.
Right, right. But I do agree that, even in our world, I often refer clients to tax professionals because
Absolutely. Oh my
honestly,
gosh.
that's
Yeah.
major. Yeah, a lot of what we do is impacted by taxes. But honestly, I can see a world where even the gentleman that I spoke about that came to see me some time ago, I can see a world where he needed to sit down with his financial advisor as well as his taxes advisor, as well as a real estate advisor,
Yeah.
to
Well,
be honest.
and it's important. I want to make sure that people understand I am not a CPA, and I do not give tax advice, nor will I ever become a CPA. And I don't work for the IRS, and I will never ever work for the IRS.
Are you
So
sure, Gail?
I
Are
am
you sure? Because you seem very sure.
sure of that. So it's just like you said, it's part of, a team approach.
Yeah.
And, we help work with CPAs, with all of the other financial professionals, whether it be your business attorney or your estate planning attorney,
I want
your
to.
business coach, your life coach, whatever, to make sure that everyone's singing off of your songbook.
Yes. Yeah, that's big. That's really big. So let me ask you this. I want to go back to this idea of a balancing act.
Okay, sure.
And I'm wondering if somebody is sitting in front of you and you see that they've been missing out on maybe some opportunities or some gains in another area. Maybe they've kind of gone heavy on one vehicle, but not another vehicle. Do you do any modeling as well for someone to be able to
Sure.
see what it could look like or what a picture could be?
Absolutely. Yep.
Okay.
We do all kinds of scenarios. The first thing we kind of figure out, though, is we want to make sure that whatever we do, it is in line with their risk assessment. What's their risk? We call it a risk score. And some people have a higher tolerance for risk than others, much like pain. Risk is really I think about it as a source of pain, or it can be. So, our main goal is to make sure you can sleep at night. if you think about investing is more like watching paint dry or grass grow. It's not excitement. If you want excitement, take $800 and go to Vegas. That's where excitement comes in. It should not come in with investing, right? We want to make sure that it is doing what you want it to do, and in that it's being monitored and you're still involved in it. But there should not be a whole lot of excitement going on with your investment portfolio. When you start feeling that excitement, then that's when you really need to kind of reassess what you have things in, because if you're nervous about everything all the time, then something's not going to plan according to plan.
That makes sense. I shudder to say that your real estate investment portfolio should be unexciting because we've mastered don't do anything, just leave it alone. We've mastered that. So I'm gonna walk it back just a little bit and say you need to check on it. Don't let the sleeping dogs lie. Just,
exactly. Yes. Yeah.
Check on it.
Yeah.
Yeah. Well, Gayle, I think this has been great. What are your last kind of thoughts about how people need to think about diversification or balancing? What do you think?
Well, I think, again, it always goes back in terms of come up with a plan and then work the plan. I mean, it's as simple as that. It's just coming up with what you want it to do. Where are you in your investing continuum? Are you, at the beginning? Are you nearing? We always look at investing kind of like a mountain, where your working years, you're climbing up the mountain, and those are your accumulation, and that's a different strategy. But as you get toward that teetering point, then you're going to have to start getting a distribution strategy, meaning taking money out. And so you have to look at where you are on that continuum, and then diversification will change based on where you are in your timeline. And so that's the one thing that we would really say that it's important to do, is just kind of figure that out, come up with a plan. And then plan doesn't mean that's etched in stone, but it's a starting point, and it's something that you talk with your advisor on a regular basis. We talk to people on a quarterly basis. They can always go call us whenever you want, but typically we like to check in on a quarterly basis to kind of help them make sure everything's going okay, and if they got any questions or life changes. But those are some of those things I would think would be important, is just come up with that plan and then make sure you're in constant contact with the people that are helping you implement it.
Yeah.
What about you?
Well, I wouldn't have anything to add besides that. Think about the outcomes that you want your investment portfolios to help you with. Who was it? Was it Covey that said begin with the end in mind?
Yes. Yep. Absolutely. Yeah. That's so true about everything,
Yeah.
And it always goes back to, like, if you get in your car, 100% of the time you have a destination in mind. Now, why don't we do that with other parts of our life?
Don't get me started. Don't even get me started. I will say this, like, as a final thought. I had seen a billionaire on something I was watching who said, concentration builds wealth, diversification keeps it.
Yeah, that is so true. That's probably why he's a billionaire.
I love that. I love that. So that's what I would leave our listeners with. Yeah.
I love it.
So we've got we talked a lot about different terms, terminology, different ideas. And so we're going to have all of that summed up in the show notes for you. So please go visit buildwealthyourway.com.
Yep, absolutely. So, but yeah, great conversation, Darice. I loved hearing about the real estate side of things and how it actually flows into the other parts of investing. So
absolutely. So Gayle, this was amazing. I'm looking forward to the next one.
Until then, take care, everyone.
Right, take care, everybody. Bye-bye.
Bye-bye.
And that's a wrap for today's episode of the Build Wealth Your Way podcast. We hope you're feeling inspired and empowered to take action on your financial journey. Remember, When women control wealth, the world changes for the better. If you enjoyed today's episode, be sure to subscribe, rate, and review us on your favorite podcast platform. Visit our website to stay connected for updates and more ways to accelerate your wealth building efforts. This is Darice Renee signing off. Stay fearless, stay fabulous, and keep building wealth your way. Build Wealth Your Way is provided for informational and educational purposes only. The content of this podcast is not intended to be a substitute for professional financial advice, diagnosis, or treatment. Always seek the advice of your financial advisor or other qualified professional with any questions you may have regarding your financial situation. The information and opinions expressed in this podcast are based on the host's experiences and research. They do not constitute financial investment, tax, or legal advice. The host and guests may have positions in the financial products or securities mentioned, which can change at times. Always conduct your own due diligence before making any financial decisions. No content in this podcast should be considered as a recommendation to buy or sell any particular investment, product, or service. Any investment decisions you make should be based on your own individual circumstances, your risk tolerance, and financial objectives.